Hello, welcome to a new episode of Talking Alpha. I'm Adam Haeems, the CEO of Alpha Chain Capital, and I'm thrilled to be joined today with Dr. Tillmann Sachs, CEO and founder of J8 Capital Management. Thanks for joining me today, Tillmann.
Hi, Adam. It's a pleasure being here.
Good to see you. So for those that aren't familiar with you or your firm, give us a brief overview on your background and how you got to where you are today.
Yeah, well, I'm German. I grew up in Germany. I'm an engineer by education, and I joined investment banks after my PhD, and there I discovered how to package futures into trading strategies to emulate popular hedge fund strategies such as trend following or term structure arbitrage. And I discovered that probably I can do it better by using my own engineering hat and my knowledge from the capital markets I've gained, and decided to create my own set of strategies. And I started trading with my own money, this set of strategies, back in 2012. And since 2015, we have finalized our strategy, and ever since we are building our track record and AUM.
Excellent. All right, and you're based in the UK, obviously, and it's a regulated entity.
Yes. So I founded J8 Capital Management back in 2012. In January 2012, we were first under the regulatory umbrella of another company for almost 5 years. And with the launch of our UCITS fund back then, we decided to go for a standalone FCA authorization. So we are fully authorized and regulated by the Financial Conduct Authority in UK. And ever since, we use that authorization obviously to manage our clients' money, but also we offer our infrastructure to other managers that are starting up and need a regulatory host.
Right. Okay. And going to the strategies that you deploy at J8, how would you describe them from a high-level perspective?
Well, broadly speaking, it's not really too much magic, but there's a lot of, let's say, attention to detail at how you actually design it. So from a high level, what it is 50% of the risk in our portfolio is, broadly speaking, just trend following, with a very simple, slow-moving trend following program on the three main asset classes of commodities, currencies, and government bonds. And we do this with futures only. So we don't trade any options, no cash instruments, futures only, unfunded futures. And the other set of the bucket is what we would call alternative risk premium strategies, which include carry trade in currencies, term structure arbitrage on commodities, where you arbitrage, the further deferred end of the curve versus the nearby end of the curve, and an inventory-driven strategy where you go long the undersupplied commodities and short the oversupplied commodities. And all these 6 sub-strategies we combine in a risk-weighted portfolio where you allocate inverse to the volatility, to the realized volatility. So you allocate more money to the less risky and less money to the more risky underlyings. And on top of that, we manage the drawdown risk by applying a target volatility mechanism. So we manage to a target volatility of 10%. And that's really the basic building blocks of the strategy. So we only do futures of the most liquid underlying markets of currencies, commodities, and government bonds. We don't do any equities. So we are completely a natural diversifier to any equity portfolio because we have 0 equity exposure. And the whole thing is multi-strat with a matrix approach. So we are diversified across asset classes and diversified across model risk. And the whole thing probably risk managed with inverse asset allocation, or inverse volatility asset allocation, and the target volatility mechanism on top.
Great. Okay, so I understand there's 6 subcategories or sub-strategies within the firm. How did you go about creating those 6 strategies? Did you start with 1, and how did it develop into 6?
Well, actually, I started out and developed about 18 different strategies. And our very initial trading set was very complex. I think we started trading with about 15 different strategies and a lot of very sophisticated filters and bells and whistles and very complex construction. But the problem is twofold. The problem is it's a very complex thing. So when suddenly, let's say, a drawdown happens, it may be very difficult to exactly attribute where a drawdown comes from. And if you lose oversight because of the complexity to exactly know what in the system is responsible for this drawdown, you start to lose faith in your own modeling. So that's happened with us, and we sat down and said, okay, key to this whole thing is simplicity. And so what we did is we took out from the different strategies that we had all redundant elements. So for example, we had trend following elements as a filter in a carry trade. Yeah. So we said here, okay, instead of and we had a trend following strategy where we then said, okay, let's say in currencies, where we then said, okay, let's take some implied volatility measures as a trigger signal or as an additional trigger signal of a price trade. Yeah, and what this does is you mix different return drivers and different risk premia in one strategy, and thereby you don't have a clear signal in the end anymore, because you mix them all up. And when you have then a number of strategies put together that all uses similar elements in their own right, you end up with a very complex mumble jumble of strategies. And what we did is we said, okay, we simplify it down. We look only at trend. So one strategy just for trend, one system just for rate differentials in currencies, one system only for volatility measures, for trend breaks out and so on. And thereby we have very clear and distinct underlying systems and strategies, and there's no redundancy effects between the strategies. So these 6 building blocks we have at the moment is, let's say, distilled out of this overall universe of plethora that we wanted to do. And of course, the number of strategies is reduced because we don't do equities anymore, because we found that equities has very little additional benefits to it, but we can discuss about that issue later. So we end up with the 6 core strategies of trend following for all 3 asset classes of commodities, currencies, and bonds. And then in the bond space, we found that carry trades or curve steepeners and flatteners are actually difficult to implement because of having the last 30 years of just really one direction of trend, meaning that the yields always go down. You get a very distorted backtest, so we just left that one out. Then in the rate space, we said, okay, what we have there as a very functioning principle is carry trade. So we added the carry trade. In the commodity space, there you have more liquidity also along the curve. So there we added very distinctly the term structure arbitrage between long and near end, which is very distinct and different from trend following, right? Because the return driver is very different. And instead of using price trend following, which you do in trend following, we use inventory fundamentals in terms of the curvature to measure the curvature, to give an indication of over and under supply, and then to go long and short respectively, which is a different signal generation engine than price, than price trend following only. And thereby, we have a subset of 6 distinctly different sub-strategies, which are fairly uncorrelated to each other, and they make a nice and well-balanced portfolio. So that's really the philosophy behind that.
Excellent. Thank you for that. Yeah, that makes total sense. And I think before we go into the details of the strategy any further, I'd love to talk about the business, J8 Capital Management. How do you find running a business as well as being a fund manager in one? What are some of the challenges you've had in setting up J8 and running it?
Well, when I started back in 2012, I grossly underestimated the effort it actually really takes to get this off the ground running. So when I started, I thought, as everybody tells you, well, look, have a year or two of nice track record, and then investors will come. Well, this didn't happen. Okay, I had a year or two of nice track record, even launched an own fund of it, with my own money, and that from family and friends, and investors wouldn't come. And I mean outside investors, third-party investors, and yeah, then the tough part starts, right? Because you have so much working capital when you start. At some point, this is used up. You have to finance your business. You have to finance the product, or subsidize it if it's small, and it just becomes a different game. So what we did is, or what I found is, because I come from investment banks, as an employee, you cannot trade your own money, right? So I never could build my own track record. So I had to start fresh when I started on my own to build a track record, and therefore I launched a fund, which in hindsight was the right decision, in Malta. Malta, because it's very cheap in operating expenses and fund operations costs. And I used then this track record to later launch a UCITS fund. And I also used then that track record, because it's also an audited track record, to attract managed account money. So that's how I built my track record, is in a very, let's say, simple or cheap fund vehicle. The miscalculation I made at that point, and I'm very happy to talk about that, is that yes, Malta is cheap and you can easily set up a fund and it's audited and great to build a track record, but to get outside investors to invest in a Maltese fund is almost impossible, because simply for many investors, just like other jurisdictions, they say we don't know it. Investors, they know Luxembourg as a fund jurisdiction, they know Ireland, maybe Cayman Islands, but that's pretty much it, I would say, in terms of fund jurisdictions that are popular and known. So if you come around as a startup with a short track record, and say, look, why don't you invest in my, I don't know, Gibraltar or Cyprus-based fund vehicle, it's very likely that they will say, yes, you have a very interesting strategy. Please come back when you are A, larger, and B, probably different jurisdiction. So that was a misjudgment of mine, which I simply just also did not know. It was not on my radar at that point in time. So that's one issue. The second issue is that to raise assets, one needs to demonstrate well-functioning operations, and it took us some time to build that up. Really, we built this up only after while we were getting our own authorization and regulations. And this is really to separate portfolio management from compliance and risk management. We have two separate functions, and a strong administration behind it in terms of making sure that all the bills are being paid and that the money is being invoiced and accounted for and audited, everything, and all compliance returns are done on time. And what we found is, once we got our own regulation, it forced us also to improve our internal processes to fit these demands. And investors also started to look at you as a company with a different view, because they do understand the value of a regulated firm and what it means to have the process in place to be fully compliant. And that was very important. And nowadays we have not only UK authorization, but also US. So we are also NFA authorized in the United States. And with that, we can manage money from US qualifying investors. So
excellent.
That's very good.
Yeah, thank you for that, Tillmann. There's lots of really interesting information there, especially for people looking to set up a fund who are completely new to this. So thank you for sharing that. You touched on segregated accounts or managed accounts and UCITS as part of your journey to where you are today. For people that don't quite understand the differences, could you explain the difference between a UCITS fund and perhaps managed account offerings?
Oh, sure. There's a world of difference. A UCITS fund is a European regulation on a fund offering that is open to retail investors. So you as a manager, you face the fund. So the fund is for you a professional investor or institutional investor as a client. And then people can buy the fund, and investors that can buy the fund can be retail investors, but also institutional investors, both. So by law and by regulation, when you offer such a product that is retailable, you have a lot of regulations and constraints to adhere to. So you have concentration limits you may not exceed. You have specific asset classes which you are not allowed to trade. You have to find certain ways how you replicate something. For example, commodities cannot be traded. Commodity futures are not allowed to be traded in a UCITS fund. So you have to find indirect replications through an index swap. So you have to find an index provider. In our case, it was Goldman Sachs, where we set up the commodity indices and then swap them in, which makes the whole thing very expensive. So you have a high cost ratio in the fund, you know, to run against the assets. You have to have a separate custodian for all assets from the so a separate custodian from the administrator, from the fund manager. So you have a lot of different parties in it. Everybody wants to be paid. Everybody needs to be organized. So it's a hugely complex animal, but it's open for retail investors. And it's probably the most common way how investors in Europe allocate money through UCITS funds. Then what you have are alternative investment funds. They are similar to UCITS in the sense that you also have the separation of custodian and brokers, but you have no more investment constraints. So that means, so for example, in UCITS, you cannot allocate more than X% of the portfolio to a single security or single markets, whereas in an alternative investment fund, you could theoretically buy all futures only. Yeah. So you don't, of course we don't do it, but theoretically you could allocate everything into one single asset. You could have any sort of concentration risks. There's no limitations to it. Also, you don't have the issue of counterparty risk, whereas in a UCITS fund, you know, you may not exceed your counterparty risk of more than 10%, or banks 20%. So you have to spread, you know, all the fund deposits across many counterparties, and you don't have this with an AFM. Then from that, if you go a step further away, you have funds that are neither UCITS nor alternative investment funds, which is also a European regulation, but what we call offshore funds. So let's say a Cayman fund. In a Cayman fund, you don't need to have a custodian. So in a Cayman fund, it is sufficient if the broker holds the assets. So for example, if you have 100 to invest and you buy 100 worth of shares, then it's okay if, you know, with a broker, you have, of course, your account of the fund. If then you simply leave it with the broker account of the fund. Whereas in a UCITS or AFM, the broker has to transfer those assets into the custodian first. So you have this transfer process, where it's then considered as safe. In a offshore fund, you can keep the assets with the broker. So what this does is it cuts out the costs of custodian. But many investors, they say, well, I don't have the safety anymore of custodian because held with the broker. So you suddenly have, the risk that the broker goes bust. So if the broker goes bust, and if your assets are not segregated with the broker, you have a problem, right? But of course, most brokers know that, and they offer segregation of those accounts. So that's fine. And then, as a next step behind that, and the fund, and the offshore fund is still a funded vehicle. So let's say if an investor buys for 100 the fund shares, the fund receives 100, and you have to think, what do I do with this money? I can buy some futures, put it in the margins, and then the rest I put in some cash instruments, let's say government bonds or whatever, just to park the cash. Now, with the next step, with a segregated managed account, when it comes to what we are doing, futures trading, you have the huge advantage that the investor does not need to pay up the full funding of what he wants to trade. So let's say if the investor says, okay, I want to have the exposure of 100 with your strategy, he only needs to post, let's say, for example, 20% or 30%, whereof, for example, 10% is for margin using, and the other 20% is to buffer drawdowns. Yeah. So he can keep 70% of this 100 and invest somewhere different. So what you can do with a managed account, you can use a managed account for portfolio overlays. You can offer it as a risk management tool to a fully funded portfolio. So let's say, for example, if an investor has already an equity portfolio, and depending on his relationship with his broker, he often doesn't even have to post more than just the margins, and he can use his existing portfolio to borrow against for the margins. So for him to implement a managed account with a broker where he already holds the other assets, he can use those assets to essentially fund the margins for your overlay strategy. So you can offer your strategy as an overlay or risk management tool over an existing portfolio. And that's of course very powerful, because here the investor, he can maintain his normal regular investment and just allocate some portion or whatever exposure he wants to your strategy as an overlay, and he doesn't need to come up with additional funding for it. And that's what makes segregated managed accounts so attractive, especially in the institutional space with investors that understand it. And interestingly enough, we found that US investors and Asian investors seem to be more familiar with this type of approach than European investors. And our strategy just lends itself very much to exactly doing that. And we focus very much on the US market at the moment.
Excellent. All right. Thank you for that. So are you seeing trends in investors demanding or preferring managed accounts over perhaps a more UCITS type product or not? What are you seeing?
Well, it's different type of investors. So for example, if I go to a German pension fund, it's very likely that they will ask for a UCITS fund. If I go to a US family office, it's very likely that they want to have a managed account only. So it's a different audience you talk to.
I see.
And I don't think that the preferences in this sense have shifted. So I have not discovered that, let's say, from investors that previously only did managed accounts, they suddenly only want to do funds, or the other way around. My experience is you have just this type of investors that want to do this style of investment, and other investors that do this style of investment. So it's different investor types, not a shift in preference.
I see. Okay, so different types of investors require different types of vehicles to participate. Okay, so now let's get back into the nitty-gritty of the trading strategies, which I'm sure lots of people want to hear about. So I think people will be interested to hear, what is the process you go through when developing a strategy for J8? What is involved there?
Well, I think the most important lesson learned, and what we definitely want to achieve, is we want to minimize the risk of fooling ourselves. Everybody who has done a little bit of modeling and strategy development knows it is very tempting and very easy to develop a strategy that looks fantastic in a backtest. And it is always the question then, in real life trading, can I meet and match that expectation that I created for my own backtest? And what we found is, when you create such a wonderful, beautiful looking backtest, it's very likely to be a singularity. And what we try to do is to build, that's a very used word, it's a robust testing environment, where we say, for example, if we choose parameters, parameterization, we don't necessarily use the parameters that give us the most nice results, but we choose that parameter where the parameter left and right of it yields similar results, because it is very likely that trading environments will change, and they will definitely change, and you want to have a certain power of predictability from your parameters that you choose for the future. So if you choose parameters where, if you would go left and right of it with other parameters, you get similar results, that is very likely to be a stable and robust choice.
Yeah, absolutely.
And this, you build up the strategy from bottom up, parameter by parameter. And of course, you have to make sure that the parameters are not redundant and don't cancel each other out. Yeah. Okay, so that's how you slowly, gradually build it up from bottom up. And then, in the end, you should have an overall robust and rigorous tested system.
Right. Yeah. So what we understand from that is, when people do their back test, and we have this at Alpha Chain Academy, 9 times out of 10, they're beautiful back tests. They're all profitable. 99% of traders have profitable back tests. And we say a similar thing to our traders. When we look at your parameters and we look to adjust the parameter sizes, what is the performance of parameters either side of the ones you've chosen? Is yours an outlier? How realistic is that going to be in live trading? So it's good to know that some of the guys here are doing something which is known in industry, which is great. So the strategy, absolutely, yeah, absolutely positive. So the strategies you've discussed, we talked about one of your trend following strategies. We've talked about your term structure arbitrage strategy as well. So for those that aren't familiar with term structure arbitrage, you've explained a little bit at the beginning, but what type of markets would you be trading in, and how would a strategy setup look like?
Well, first of all, we need to understand what actually does it mean, a term structure arbitrage. And when you talk about a term structure, term means time, right? Time is another word for term. So it's a time arbitrage. So you arbitrage something with a longer term outlook versus something with a shorter term outlook. Because arbitrage means to trade against each other, is to arbitrage. So practically speaking, if I want to take it from a very simplistic point, you can say that if I live today, I have a fairly good understanding or idea what may happen today and tomorrow, maybe to a week out. But anything that's out, let's say half a year or a year, I'm not so sure about. So if you look at interest rates, that's the best example. The near-term interest rates are low because it's low risk to lend against you, right? But if you look further out, there's much more risk involved. That's why the interest rate is higher. There's more uncertainty. That's why if you want to lend out or borrow long-term funds, it's always more expensive than short-term funds. From a banking perspective. So you can transfer this into asset prices. So for instance, a nearby commodity future, let's say for example, with a high storage cost. Okay, let's not take natural gas because there's a lot of seasonality in it, but actually it's a good idea. Natural gas, you have high storage costs because gas can easily evaporate everywhere out. So it's very expensive to build those gas storage containers, deep in the ground. It needs to be maintained, it needs to be financed. So if gas is delivered and you say, I only want to take it in a year's time, then you say, okay, if I give a commitment to take it in a year's time, I have to pay a higher price than today if I would take it now, because I need to finance the guy that is giving the storage, to have his storage facilities so that he can pay off, his banks to refinance the storage facility, right? That's essentially. So what you have is you have a so-called term structure where the nearby future, in an ideal world, okay? In an ideal world, the nearby future has a lower price than the future further out in the future. So let's say a future with delivery in a year's time normally is higher noted than a future nearby. Let's say if demand and supply is constant and so on. Yeah. So and this curve you can imagine it's like rolling down. It has a curvature. It is not linear. It has a curvature. And the curvature on the near end is much steeper than the curvature on the long end. So term structure arbitrage is when I take a position on the long end. Let's say I start now with a position. After a month, it rolls down. And I have a certain roll loss, what is called roll yield loss. You have a negative roll yield. You lose some money. When you take a position on the short end, the rolling down in a month is much greater. So you take a short position here, short position, and you make money on the short position, which ideally is more money that you make than on the long end. Yeah. Now that is the basic idea of a term structure arbitrage trade. That let's say with 100 investment, I go 50 long and 50 short. Yeah. And that has its own problems in it because, of course, in an ideal world, this would be the way how it works. But reality is, of course, that it doesn't. And what you have, reality is, of course, you have demand and supply movements, and the short end is much more volatile than the long end, and you can have suddenly a supply shock. So, for example, if suddenly a war starts in the Middle East, you may have a supply shock on oil, and the short end goes up because you suddenly have a spike in oil prices. Everybody wants to cover the oil demand, and then you see that the curve is the other way around. So that is the natural losing position for this type of trade. Yeah. Right. And you, of course, need to have a good understanding of the markets, what you do to design a system around it that can risk manage it, that can deal with this type of problem. So every trade you do, be it term structure arbitrage, be it trend following, you always have an ideal environment where it works. And most of the time you're in an adverse environment where it doesn't work. You have to find a way how to deal with that, how to manage that. And that's the whole trick to it, really.
Got it. So if I understand correctly, you would go short the near month future, you'd long the further out future. And although you're trading the same market, albeit at different expiries, different terms, you're not actually market neutral, if I understand correctly, because the near month could be more volatile than the far month. Is that correct?
That is correct. Yeah.
Okay.
That is correct. So in terms of risk, you have more risk on the shorter end because it's more volatile than the long end. Yeah.
Excellent. Okay. And your trend following strategy. So how would you describe your particular strategy at J8?
Well, we are certainly long-term. Long-term means we look at prices back maybe a year and a half, sometimes 2 years, sometimes just half a year, really depending on the underlyings. So you have a difference, for instance, with seasonality commodities. You want to be close to a year because you have the seasonalities in it, the seasonality effect. Other commodities or underlyings, you don't have seasonality effects, so you can do shorter term. But what we found is it is very dangerous to be caught in whipsaws. And there's a certain natural volatility with every underlying. And what you don't want to do is you don't want to suddenly always change a trading position from long to short, just following the natural volatility of a price swing, because this will catch you always on the, or most of the time on the wrong foot, where where you're long when it goes down and you're short when it goes back up again, and that's of course very painful. So you want to have a system that is either that responsive that it can do these intraday swings or this volatility. So super short term with a lot of data of intraday points. I mean, I know traders that do that, right? That trade this intraday very successfully. But this is not something that we do. And what we say is we rather ride along those swings, and only our trend following kicks in when a significant long-term trend materializes. So it's outside of these normal swing areas. And then it persists, then we switch position. They can still be wrong. No? Don't get me wrong. You can still be on the wrong foot, but you're less often on the wrong foot. And that's how we approach that. So rather long-term, strategic, long-term. We ride out swings, which can sometimes be annoying and painful, but long-term, we seem to make money with it, so it's okay.
Great. And do you use stops or take profits in this type of trend following strategy, or do you purely wait for a new signal to come?
Well, in our case, we don't do stop orders or taking profits, because that would be like a second system on top of the first system. And then you can argue, why do you research and develop a first system in the first place if you then don't believe and trust your own system and you need to have a second system on top? So so it all breaks down to risk management, right? I mean, we're talking all about this risk management. And if you say, look, for instance, I only trade markets long only, and for that I need to have a good risk management system around with stop losses and taking profit, fair enough. Because then your proposition is a different proposition. Then you say, I'm not interested in trends. I'm interested in banking profits and cutting losses from a long-only perspective. Mm-hmm. That's a different statement than saying you try to profit from up markets and down markets by taking long and short positions, which you do in trend following. At least in my opinion. So if you do so we don't do stop losses. We don't do taking profits and cutting losses early, because we say we let the trends play out. And if you want to fully benefit from a trend and you are only partially invested, you also don't have the upside as you have from the downside. As you know very well, often the downside comes much faster and quicker than the upside. So you want to make sure that you still have your firepower to take the opportunity when it goes back up, and not that you're suddenly deleveraged out, levered out, deleveraged, and stopped out, and you miss the recovery.
Understood. And
because swings are part of the game.
Yeah, absolutely. You've talked how you don't trade equity markets, and if I understand correctly, you do that to allow for more diversification, for your investors, I suppose. So it's less correlated to what their typical investor portfolio may look like. But how many markets do you trade in the trend following strategy in total?
Well, yes, Adam, that is exactly correct. We don't do equities because we see equities as a redundant asset to commodities, currencies, and bonds. Because every company, in those, let's put it this way, futures you only have on the large indices, such as the S&P 500 or the Euro Stoxx 50 or the Nikkei or other indices. You have futures, and there's big companies in there, and these companies trade international markets, so they have currency exposure. They somehow rely on some sort of resources, or often on resources, so you have the commodity part, and they rely on a financing structure, so you have the rates part. Yeah. So we say, okay, we simply take them out because we already have that bucket in there. So we have not the redundancy. I just want to make one point here very clear. I do not say that equity investment doesn't make sense. Okay, I know very good equity investors and managers that do a fantastic job in stock picking, or also in systematically trading just equity markets only. It's just that in our approach, we focus purely on the FIC markets, the fixed income, currency, and commodity markets. And those markets we see separate from equity markets. Whereas in equity itself, what is issued, it has no more economic value to a firm. It's a 100% speculative instrument. Whereas commodity future always has an economic relevance. So it's also very different in nature of the underlying. Plus, of course, index futures are futures on an index. And the index rebalances, has a survival bias in it, etc. So it's very different, to have a trend following on an index versus, a single underlying commodity that can tank and then have a recovery. And you can find different trend patterns on a single underlying commodity, let's say, versus an index that is mean reverting essentially and has a survival bias. So in the modeling, we found it also very difficult to model interest rate, to model equity indices. But coming back to your question, so on the trend following side, we only do trend following on those markets that are not correlated to each other and have nothing to do with each other. So, for example, we do a trend following on US rates, on European rates, and Canadian rates. And in the commodity space, we do trend following only on one single oil future. Natural gas, of course. And then from the grains and softs, we only pick one single commodity that is not correlated to others. So that is really to pick the representative markets, the representative global markets, and not to have a current redundancy effect. So, for example, if you would trade a Brent future, so just as an example, if you would trade a North Sea Brent future, a American West Texas WTI crude oil future, and let's say a gasoline future and a heating oil future, these are highly correlated markets. So in trend following, if I would allocate to all these, you may have the same signal in all markets, and suddenly they make out 20% of your overall portfolio allocation, and that's just a very lumped lumped exposure, and you don't want to have that. So we have our trend following distinct global markets that are distinctly separate from each other in terms of the underlying drivers. So for example, an oil market has a very different driver than the wheat market. And the wheat market has a very different driver than gold. So that's how we pick the markets.
Interesting, because I think we're aware that some trend following businesses have different thoughts around number of markets and the benefits of diversification of those markets. Some, as I believe, are of the opinion like you, where if you combine several oil markets together and you allocate risk between them equally, like you would your equity markets, you get some concentration risk, as you pointed out. And then others think perhaps that the more markets you have, the better, the more diversification benefits you get to the whole portfolio. Of course, assuming there aren't too many concentration risks within that. Are you of the opinion that more markets generally can be better, assuming that you don't have any lumpy risk concentrations in your number of markets? Or do you think actually there's an optimal number of markets for a trend following strategy such as yours?
That's a super interesting question. I mean, apart from the fact that if you have a super broad diversified portfolio, let's say with a lot of markets in it, you also need to have a lot of money to trade it. Because simply of the notional exposure, of course, goes up, right? And you still have the contract sizes to be satisfied. But apart from that issue, in the course of the development of our strategies, we made a survey back in 2014, 15, and 17. And we asked investors, managers, consultants, and brokers, we asked them what they think are the most popular markets that are being traded by systematic CTA managers, managed futures managers. And we asked them to prioritize a selection of 82 markets. And we also asked them what they think is the most common way to trade these markets. And the answer, and the risk management too, and the fee structure. And the answer from the survey, we put that into a very simple index model. And the survey came back that essentially if you take the 6 most popular markets, which in this case was the S&P 500, the US 10-year T-note, the US 10-year Treasury T-note, gold, WTI crude oil, copper, and the Euro FX. If you take these 6 markets with a 12-month momentum model, where you simply look, on a rolling futures basis, today's index value versus a year ago, long short, in a risk-weighted portfolio with a target vol on top, that you beat popular benchmark indices from our industry. So let's say, for example, the SocGen CTA index, which was previously the New Age CTA index, or the trend index, or from HFR, the indices, or Credit Suisse. There's a number of CTA indices out there that outperform them, but that the overall movements are very similar. So, but you still have a high correlation to them. So you still have a correlation of like 0.6, 0.65, but you outperform. And this shows 2 things. One is the survival bias, of course, of the indices. That when they pick good traders that go into the index, they may not perform so well after they've been chosen, which is also a typical investor bias, by the way. Investors love to chase performance, even though they tell you they don't, but most investors do love to chase performance. Then they invest and then they're very disappointed because they invest based on past results, and the future is always different. So actually, at the moment, we are trying to tell investors that they should try to allocate in drawdown phases, which is actually quite a tricky pitch, because many investors, just from natural bias, they like to buy performance and they don't like to buy in drawdown. So that's always interesting. But But what we showed is that with a very simple model, you can outperform the markets, and you don't need to have 50 futures in it to achieve the same result. And thereby we could scientifically prove that with a selection of the core global markets, you can actually replicate well-diversified CTA industry. And so back to your question, whether you need a very broad portfolio, is always the question, what is the value add? And to me, I'd rather keep it simple and take out complexity, but understand where the return drivers come from, than to have huge complexity with an overly broad portfolio where in the end you may lose oversight.
Yes, understood. So I think also when we have a higher number of markets, what we also end up doing is reducing the risk in each of those markets, right? We're allocating risk evenly across your basket of markets. So by having a smaller number of markets, you have a higher degree of risk. And if they're well diversified, then perhaps, yeah, as you say, your findings found that performance can be better than a standard basket.
So of course, to say 6 is of course a very small number. And of course we trade more than 6 markets. We trade, I think, roughly 25 or 30 markets approximately. But I don't think you have to go into the hundreds markets, But I think a reasonable diversification is somewhere between 15 to 25. From my gut feeling, that's totally sufficient.
From what I've been reading online about J8 Capital, I understand that risk management is a core focus for you guys at J8.
Yeah.
So when we're looking at how you might allocate risk between those markets that you've selected, how does that work in practice?
Well, as famously Farmer and French said, the only free lunch you have is diversification. Diversification is our first layer of risk management. So first we say, how do we allocate between the different asset classes? And here we define simply risk as the volatility. One could also define the risk, for example, by volatility over drawdown, which is a very interesting ratio, because it shows you the risk of loss of capital per amount of volatility. Yeah? And we inverse weight it. So what you want to achieve, you want to have portfolio stability. So you allocate less money to the more volatile and more money to the less volatile. So that's a very common approach. That's risk parity essentially. Right? It's this approach of risk rating. But then important then is still to say, okay, how do I manage my exposure? And since we are trading unfunded futures, we have the luxury of being able to apply leverage as we like it to achieve a certain risk exposure. And what we say is we want to achieve a certain target volatility of the program, and then increase or reduce the leverage to exactly get that target volatility done. And what then we say on top of that is we want to limit our downside risk, because I'm trading my own money and I always hate losing money. That's a very interesting behavioral finance insight, is when an investor makes 10%, he's happy. If he loses 10%, the pain of loss is twice as strong as the happiness of a gain, right? So what we do is, when we experience a strong drawdown phase for, let's say, a single underlying sub-strategy, and if it exceeds a certain expectation, historically, we don't know how much longer this downtrend may be going on, we simply close it out until it recovers. So that is one of the drawdown measurements, or drawdown risk approaches, and thereby we reduce the overall leverage in the portfolio too, right? Because we close out the allocation to an entire sub-strategy set. And we have on an overall portfolio level also to say if the overall portfolio within a quarter exceeds a certain drawdown, we reduce the overall portfolio exposure. On top of that, yeah. Well knowing that we may give up some on the upside too, right? Because if you deleverage in a drawdown phase and then you have a rebound, you also don't take the rebound. But we limit this risk to quarter. So quarter by quarter, we go back full in, as the system would say, and then see if the drawdown persists or if you can take the next leg of the recovery. And that seems to be working fairly well. So what we discovered, investors, even though they always tell you that they want to understand everything underlying, they love to buy performance long term. Everybody hates to lose money. And investors seem to be more comfortable with a consistent return stream and a clearly risk-managed framework around it, where they can be sure, or let's say at least have some certainty that it won't be a total disaster, yeah? To say the least, or to be well managed, so that there's always a chance of recovery to make the money back and for excess return, yeah, over that. And that's very important, because in the end, you are managing money of a third party. It's not your own money. It's money of a third party, and they have a certain trust in whatever you do, and you don't want to disappoint on that trust, and you have to manage the money responsibly.
Interesting. So if I understand correctly, you have these 6 subcategories and you specify a max or area of drawdown or length of drawdown, at which point you may stop allocating risk to that subcategory. Is that right?
That's correct, yes. Because as we have alluded at the very beginning of this interview, there's always the big risk of cheating yourself when you do a backtest. And even though I think we use all sorts of prudent measures to come up with the most robust and realistic backtest that reflects to the future, there's still undoubtedly is always a bias in it. And you never know when reality bites you and hits against this bias, right? So we, as a protection against our own incompleteness as human beings, against completely objective in all circumstances, as a hedge against that, we say, okay, if one of our well-tested and developed strategies suddenly performs completely outside of our expectation, we close it down until it recovers and goes back. So when it recovers a certain amount from the bottom, where again we say that it's now outside of its normal swing, we go back in, and then you can still have a substantial recovery. Then you can still enjoy a substantial recovery. But whatever is happening in the doldrums, bottom parts of the strategy, you don't really want to be involved on an unexpected ride, and not knowing where it goes. Yeah.
Understood. Thank you for that. I think there's a lot of detail on your trading strategies there, and I know lots of people appreciate the level of detail you went in. So,
but now again, and this is very important, what we also touched on earlier, it is a very simple parameters strategy, but there's a lot of detail in it that in the end makes it a complex undertaking, but without having redundancies of the different elements. These are distinct, separate elements. They're all well researched and put together. And completely you want to avoid redundancy effects that suddenly can knock you out.
Got it. Okay. So coming to the end of the interview now, I'd like to maybe pick your brains on advice for new traders. So, we work with many new young traders with high ambitions. Many want to start their own strategy. Many want to go work in a firm, perhaps something like yours or another type of fund. What advice would you give to someone starting out who wants to join as a junior at a fund?
Well, this now sounds, of course, very high level, but it always depends on how you want to do what role. But essentially, be true to yourself and don't be fooled by peer pressure. What I found very irritating in the beginning when I set out with my whole endeavor of being on my own is, when you look around, left, right, center, you see great success stories of outsized enormous returns and huge assets being raised, and the rocket manager. Well, guess what? Maybe 0.2% or 0.5% of all people that start out or want to start out actually make it in the end. Yeah? So there's a high likelihood that you are not part of it. And my advice there is simply, whatever you do it very conscientiously and rigorously and carefully. Build your back tests, your model carefully. Understand why you do something really. Don't close your eyes to criticism. Criticism is the most important thing. I mean, everybody hates it, but in the end, this is probably the only time when you actually have a chance to reflect on actually what you are doing. Don't be caught in your own world for too long. Try to exchange with many people. What I experience from many traders is they are so engrossed and so in love with their strategy, they will never share any of their thoughts with anybody else because they're afraid that anybody else may want to steal their brilliant ideas. I find the opposite is true because when you share, you not only talk about it and reflect on it and maybe get new ideas, you also have other persons to reflect on this idea and in the end maybe give you feedback and you can make it better. And what I never found in my entire time is that somebody else says, wow, Tillmann has such a great idea, now I have to copy him. I've never seen that, because I think in the world that we do, in creating our own trading strategies and offering it to investors, everybody in the end wants to create their own. And there are, this is a big issue, right? That people are afraid that others may steal their ideas, but de facto, how you then implement it in the end correctly and consistently, that's you, and nobody else can replicate this. So just don't be afraid to share and learn from sharing. That's very important. Also, when you join a fund, don't suddenly think that everybody expects you to be Einstein. Nobody expects that. Ask relevant and correct questions. No question is wrong. Just the answer is stupid. And just diligently work your way through.
Great advice. Tillmann, thank you very much for taking time for this interview. I know you're a very busy man, so we definitely appreciate that. If people want to find out more about you and what you do, where can we direct them?
Well, we have a website. There's also a lot of video material on it. I think we publish about 11 or 12 videos where I describe different aspects of our strategy, of the philosophy, of the markets in general, of the industry, about ourselves. So there's a lot to read. Obviously, don't hesitate to contact me directly. And yeah, always open for discussions. And yeah, that's really the best way. I think everybody knows how to get hold of you. So
Yes, absolutely. And your website is www.j8capital.com?
Yes, www.j, like the letter J, the number 8, so J8, and then capital.com in one word, j8capital.com.
Brilliant. Dr. Tillmann Sachs, thank you very much for your time and wish you the best of luck.
Adam, thank you very much for this opportunity.
Thank you. Bye-bye.
Thank you.